Hello, welcome back to WINFXTRADING YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. It's been a long time uploading content simply because I first look on the problems faced by traders and I have to go a long way to make a search about those problems and find solution to those problems. Right now, if this is your first time of visiting this YouTube channel, do your best to subscribe and turn on the bell notification so you get notified each time I upload a new content, and try to refer your network to this channel so that YouTube will push us to high level of audience. Today's topic, we shall be discussing entry error analysis 2 in Forex synthetic market. Entry error analysis 2 in Forex synthetic market. You see, I have actually treated this topic in part 1, so this is part 2. Okay, now you should understand the meaning of error. When you do measurements, you have deviation from the real value due to maybe human errors or due to improper materials, improper elements, improper tools used in the measurement. Now, as a technical analyst in the Forex synthetic market, you're actually deploying lines, you are deploying rectangles, you are deploying other objects like channels, moving averages in terms of indicators, just to get the true direction of the market. But at the end, you still lose money. So why do you keep losing money? What makes you keep losing money? 80% to 90% traders lose money. So why do you keep losing money? This is what I'm going to treat further in this video. In the first part of this video, I talk about error in form of mathematical precisions, in form of a kind of percentage with respect to real and accurate price, accurate entry price. Okay, now every price is tradable, but not all tradable prices are profitable. You see, when you trade a particular price, whether you buy or sell, that price can give rise to an output that is continuous or an output that is reversal. Okay, so if the error associated with your entry is 0, you will actually hit your take profits with little or no drawdown. But if the error with respect to your entry is far from 0, maybe it's not it's not equal to 0, but it is not 0 but very close to 0, then it is a measurable error. So this type of stuff can lead to a lot of losses. Okay, so in this course, in this video, the error becomes a variable that controls the direction of the price. If you actually deal with the errors, the direction of the true direction of the market will evolve so easily without much stress. So the error E, because we are going to be treating error as E, so the error E becomes a variable. The error E becomes a variable that determines the direction of the market. Okay, the direction of the asset. You see, price P supposed to be a function of time. Okay, but if we represent price as a function of time, that doesn't actually represent the direction of the price movement. It is actually showing you the various values the price can take at various times. What about the direction? So you see, the price as a vector quantity will be a kind of the component of the price in the direction of the impulse I plus the component of the price in the direction of the retracement R. So this fully represent price as a vector quantity. Okay, but that they are actually function of time. Okay, but despite having the knowledge of impulses and retracement, you will still lose money if you do not represent price as a function of error. So in this case, we will represent price as a function of time and what? Error, E. So this error will be a variable, and so the error is actually, you can plot it, is a surface. So if you plot the graph of price against time and error, it becomes a surface, a two-dimensional surface, I'm sorry, a 3D surface. So this is no longer 2D, we are now going to 3D. So you have the price as is P, and then you have the error as is E, and then you have these are perpendicular to each other. You have the time as is T. Okay, so for every value of E and E, you have the value of the price being represented in both magnitude and direction using the impulse vectors and retracement vectors. Okay, well, I will not go deep into this analysis of price as a vector quantity, but I'll pretty much consider the error issues as a determinant of direction. The error will not completely determine the direction of the market, but it will help if you couple it with the vector units, which are the retracement impulse and retracement units. If you couple it with the error function, you will be able to determine the absolute direction of the market. Okay, so that's cool, and these are the things I'm going to be discussing in this video. So right now I'm going to go into the full application of this error, but we start with the calculation of the error, because if you cannot measure the error, then you cannot be able to deploy it in the determination of the direction, or in making the direction more more rewarding in removing, because the essence of the error is to remove the drawdown. So I'm going to show you how this thing is going to work. So right now we start with 2D form of price function P, and then we draw the price on the vertical axis and the time on the horizontal axis. So we have the origin. I'm going to introduce the error axis. So I'm going to introduce the error axis later in this discussion, in this practical part of this. So when you have the price and you have the origin, then you have the time on the horizontal axis, the error will come in as a third axis, but I'm not going to draw it. I will draw it later. So when price move like this is uptrend market, so price gradually move up and then start dropping by a retracement vector, and then push up again and stop and start dropping by the retracement vector. So this movement from here, the movement in the upward direction is directed by impulse vector I, and the movement to the downward direction is directed by the retracement vector R. Okay, and you see each of these vectors are sinusoidal. That means they are wave in nature, like they are wavy, like they move like wave. Okay, so the actual representation of this will be like, we have a wave that gradually went up, and a wave that gradually go down, and a wave that go up again, and a wave that gradually come down. So a wave is made up of two components: retracement and impulse vector. Then we have major impulse
event and measure retracement event, but in each of these events the impulses and the retracements must occur simultaneously. That's why each part is a wave path. Okay, now if a market is trending up, what do? You try to buy. But the problem is some traders will, for the fact they actually know that this market is uptrend, some traders will like to buy here on this turning point here. Some trader would like to buy while it is on retracement, which is somewhere here, while some traders will like to buy elsewhere. Okay, there are various positions where you can take on the trade, but because this position is not the same thing as a zero error position, like the position where you're going to enter the market and then the error will be zero. They're not just like that. So to actually make your entry have zero error, it is something more complicated, because for such to happen you must learn how to measure errors. So as I'm going to the charts, that is the focus of the next theme of this video. You are going to learn how to calculate errors, how to measure errors. Okay, but to make it so like to simplify it here, I'll just touch it small and then I'll go over to the chart. Now if you want to buy a market, you want to buy at a low price, but there is no particular mathematical formula that can be used to actually calculate a valid low price, because in these studies I will be talking about valid trade, valid action. A valid action is action that break level in this direction. It break previous turning points, it break previous critical point. An example is a retracement is a valid an example of valid action is impulse. So any impulse that break level is a valid action. Okay, so if impulses break level to the upside, then we say the market is validly trending up, and if impulses break levels to the downside, we say that the market is validly trending downwards. Okay, so this validity effect now is very complicated to actually know where it will happen, and therefore there is no way you can know the exact low or high in the market with a mathematical formula. There is no mathematical formula that will do that, but we can derive an approximate mathematical formula for that, which is beyond the scope of this video, but it is not the exact. But with it you can actually approximate it. Once the such is approximated, you see that if you buy a market, it will just buy without drawdown, and if you sell a market, it will just sell without drawdown. Okay, so right now I've been talking about how this error affects your profit or loss, but I've not said how you can actually implement it. When you look on the chart, how do you know that your entry is full of errors? How do you know that your entry is okay, there is no error? How do you know all that? Now you start by following this rule of thumb: buy low and sell high, buy low and sell high. Okay, so anytime you deviate from buying low, you are having error in your entry, and anytime you deviate from selling high, you are having error in your entry. Okay, now a retracement is an input to an impulse. So for impulse to occur, a retracement must happen. That means every retracement must create an impulse. The market have to pull back for a major move to happen, for a valid action, which is the impulse, to happen. Okay, so if any trade you are placed with when there is no valid retracement, when there is no retracement, but in this case we have to use valid retracement. Okay, yes, valid action means impulse, but we still have valid retracement. A valid retracement is a major retracement that break level. Why you have to wait for this type of action to happen is because such retracement are the ones that used to wipe accounts, because during their period, during their when they are happening, during the time they are happening, they are going to trigger every stop losses of traders who do not understand this event. Okay, so the earlier you understand how to be patient for this type of valid action to happen, the better you become error-free trader. Okay, right now we have an impulse like this in this direction, and then we have a pullback in this direction. Okay, so if this pullback is breaking level while it is pulling back, it is actually triggering stop losses of buyers who entered this market when it was going on. And there are some buyers who are not patient enough to wait for this type of event to happen. They actually enter this market somewhere here or elsewhere, and when this pullback happens, all their stop losses are triggered. Unless you are stopless trader, like you don't use stop loss, and in that case, you are two things is going to happen. Either you are exposing all your equity to risk, or you have an infinite equity that no matter how the market goes, is going to fall in your favor. But in reality, most traders are broke. Most traders don't have enough capital. Okay, right now I've actually made this thing applicable in a way. But let's think about something small, about the calculation of errors, and then we can go to the 𝒓𝒂𝒂𝒂 for practicability. Right now, if we have the price as is, P, and then we have these are vertical lines that are perpendicular to each other. Okay, so you have this and then you have this. I can't draw it fully correct, but you can understand it that these are perpendicular. So this is time and this is price. Okay, now if you suppose, let's say you want to take a buy action, you want to buy this market because you have known it's going to buy, right? If you enter this market at a price P, this P is going to be error. Like we will not say it is erroneous, like erroneous price, but we can take this P as entry price, that is PE. Okay, and then we now have P0, P0, which is absolute price. This price, it is hard to mathematically predict this price, but by practice and by consistent study of the price movement, you might be able to do that with that. Like in the long run, you will be able to know the absolute price to enter the market. But as a beginner in trading and as somebody that is still not conversant with technical analysis, you will always have errors. Depending on your emotion and psychology, you definitely enter the market at the wrong price and at the wrong time. Okay, so when you calculate the relative value of this P0 minus PE divided by P0, which is the absolute price, times 100 over 1, that will give you the percentage error. This error is supposed to be in, like, for your entry to be error free, or for you to get a zero error entry, because it is only zero error entry that will ensure that you hit your take profit, right? Yes, because that's the presence of error in your signal, in your entry, shows that you are likely going to hit your stop loss. So when this error is 0, you will not hit your stop loss, rather you hit your take profit. So this error is what I have actually calculated. I'm going to repeat the formula again. P0 minus PE. Take the absolute value, even if it is the negative value, it doesn't matter. Assume it, convert it to positive. Just remove the negative sign, and then divide this by P0, and then multiply by 100. Okay, so this is the percentage error. This for your entry to be error-free or to be highly profitable, because this thing is equals to E%. So this percentage error E should be in order of 0.00s. Wait, let me correct this. 0.0s. Okay, so if you calculate your error and it's 0.01, 0.02, this is to 2 decimal places. Okay, 0.01, 0.02 to 0.09. It means that, okay, 0 to 0.09 is not going to be reasonable here. So let's make it 0.00 to 0.05. So if your error is within 0.00 to 0.05, then it is called error-free or zero error entry. But once your error is from 0.06 to 0.09, it is called medium error. This type of error, your trading will just oscillate between profit and loss, and finally you will hit your take profit. Okay, and then we have absolute errors, like we have like this one is pre-error, like this error is present and is going to lead to losses. Okay, so any error more than 0.1% is very, very disastrous. Okay, you can see now, based on your skill, your psychology, your emotions, and other metaphysical stuff that influence your trading, your errors are going to be variable. The error is going to be a variable. Like at different time, the error, output different values. Because it's a function of time and who you are. So the error is a mathematical function of time. So the values of this error will change over time. It will be changed. It will not actually be constant. You can't say as a trader your error bound is just 0.01%. It's not possible. You can have 0.01% error today. In the next 1 hour you have 0.05%. Tomorrow you have 0.1%. In the next week you have 0.5%. So you see that the error is a variable, and as this error keeps changing, that is how your profit or loss will keep changing. The more you are erroneous, the more you lose, and the more your error is free, the better, the more profit you make, if other things are put into consideration. Right now the video is taking time. The video is actually taking time, and this is 24 minutes video. We're already 24 minutes in this video, but I'm going to make sure we don't exceed 30 minutes. Okay, I make it long so that you get the gist of what this thing is all about. And right now we are going to MT5 to apply this, and you see how this thing is going to work for you. It jumps 75 index in 1 hour time frame. Okay, it is assumed that you have done every other technical analysis, every other technical stuff you have to do in the market. You have done all the technical stuff. It remains the error analysis. Okay, we know that on like the plane of this market is pointing to the downside. This market is downtrend, right? Now mark, like as analysts, as a technical analyst, mark where there are probabilities of getting a down signal, which is a sell signal. So you can use a rectangle to draw it. So within this, as price geometrically approach this upper trend line, there are probabilities of sales here. So you can just use a small rectangle of certain thickness, with a measurable thickness, with a small thickness, like a thickness that if you look at it, you can use it to judge what is happening in the market, or you can just you can just use arrow to trace the path taken by the price. Once it reaches the trend line, then what you need to do is just measure this arrow, measure the height of the arrow, and then use it to represent the region in the chart where there are probabilities of such signal, or if there are swings where such type of signal happen, then you can use them in form of support and resistance. So you can use the weak rejections within those sessions, and then that's cool. You see, I'm not teaching technical analysis, I'm just teaching error. So right here, you see, as price is approaching here, this is where this session, this region is where there are probabilities of generating P0. This is more of discrete analysis than continuous analysis, because you have to see it as a discrete action where where prices are sampled at different times, and these price samples actually have, like, they take different positions, different levels, different values, okay? But you don't know the one that is going to give you error-free signal, okay? So there are a lot of traders are actually selling this market somewhere here. Some are selling here, some can still sell here, because the emotion that this market is downtrend will make you do a lot of stuff here just to either make or lose money. So some will sell here. When they sold here, they still make profit. Yeah, but the thing is, at the end, does it worth it? Well, what is your risk reward, and where did you place your SL? Because once you take a sell here, we know that it's going to sell, but the probability here is a buy, and that's what happened. The market bought, so there is error selling here. Then if you take a sell here, it will sell small, and then it will take you out. So long you are actually trying to get a reasonable profit, if the error will keep hitting your SL, it will lead to hit of your SL. I see, if you sell here, it will be a little bit reasonable, and the market push higher and take you out. Okay, these are error effects, making, like, trying to determine how the market is going to move, or whether you are going to succeed making profit or not. Okay, so each time you are entering a market, ask yourself this question: the error, whether there are spiritual forces trying to make you lose money. Once you know the error part of trading, this error course, once you study this course, this video, and you understand things about errors, this error I'm talking about, I'm telling you the truth, the spirit will just bow for you, because the spirit is actually controlling your mind. So what do you feed your mind with will determine how far you. Just before you take trade, make sure you study the error. Okay, imagine taking a sell here. What happened? The market go up and then start selling. It will take you out first and then sell. How will you feel? Like you keep losing. Okay, so when you are planning to enter this market here, it is called PE, but you know truly in your mind that this is where you're supposed to enter this market. So So this is peanut. So you enter this market at this price, which is 16,748, but where you're supposed to have entered it is at 18,020. Let's call it 18,000. So if you measure the price difference, you divide it by this price. Okay, let's say this price is, because let me just use calculator and calculate this and show you the result. Okay, right now you see I've done the error calculation and we have 7% error. So if you look at what I said before, I say if the error is more than 0.1%, it's going to lead to loss. Definitely you are going to lose money. Okay, now you see the error is 7% error. This is a massive error, 7% error. Okay, so when you calculate this error, even if you're under heavy spiritual forces that can actually make you to lose money, even if you're under witchcraft, there is no way you will obey, because there is no witchcraft more than mathematics. Are you getting it? So 7%, if you still go ahead and place the trade, it means you just want to lose, because the 7% is telling you don't trade, you are on error entry, don't trade, and you still go ahead and place that trade, you will lose, because the error is like magnets. Once the error is sampled and it is within certain range, it's going to draw price against you. It's going to make price move against you. But if the error approaches 0, it's going to make price move in your favor. Okay, I'll be ending this video. Thank you and bye for now.